Happy Friday, Brian Manning here at the Weekly Update. Let's get right to it. Another week's gone by. Let's see what we got going on. So Monday of this week was a relatively quiet news day. Tuesday this week, we got some housing information. So the first thing we got is a report from the FHFA. This gives us feedback on appreciation for the month of December. So the FHFA measures houses across the country that have a conventional mortgage attached to them. So this is for the month of December. And on a year-over-year basis, appreciation there was up 11.4%, which is phenomenal. We also got Case-Shiller on Tuesday, and Case-Shiller looks at home appreciation for houses across the country. And on a year-over-year basis, homes were up 10.4% from the month of December. So basically, the numbers that came in for 2020 on a national level is that home appreciation was up 10.4%, which is really phenomenal to see. Very strong, robust housing market. Anticipation for appreciation in the year of 2021 is at 7.5%, maybe a little bit conservative, but conservative predictions are okay there. But we'd say we'll see about 7.5% appreciation here. Wednesday of this week, we got new home sales. New home sales on a month-over-month basis for January were up 4%, and then December was revised even higher. So in the new construction front, just a very robust, strong housing market as well. Thursday, we got pending home sales. My gosh, tons of housing data this week. Pending home sales were up 13% on a year-over-year basis. So again, strong housing demand, and it's really good to see a strong pending home sales report. Today, we get what's called the PCE. The PCE is the personal consumption expenditure. This is the Federal Reserve's favorite gauge for inflation. And when we look at PCE, there's what's called the headline and there's a core rate. So the core rate strips out two volatile items, which are the cost of food and the cost of energy. If we look at energy over the last year or 2 years, oil prices, et cetera, they go up, they go down. So we look at the core rate, it strips out those two volatile items, food and energy. And on a month-over-month basis, PCE was up 0.3%. And on a year-over-year basis, the inflation level went up from 1.3% to 1.5%. So the Federal Reserve is very vocal in saying they'll let inflation run up to 2%, perhaps even a little bit higher before they start raising rates, but they're very vocal in saying we're going to keep rates at zero for right now. We had Jerome Powell talking this week and just reassuring us that rates are going to stay at near zero for a very long time. So we'll have to wait and see what happens, but inflation certainly was in check based on this report today. One thing I also want to look at today is just the charts real quick of what's going on. So this is the yield in the 10-year Treasury. And, back, let's see, when this back a couple weeks ago, we were looking at the yield right here, and we said, hey, if the yield breaks above right here, and mortgage rates will typically follow suit, and the general direction of what the yield in this 10-year Treasury is doing, that we might see some serious changes coming up. So right here, we broke above this. And then as you can see over the last several days, the yield in the 10-year Treasury has really continued to rise. And yesterday, we got up to a relatively high number of 1.6%. And it's interesting, it hit this ceiling and it did come back down. But, we're not out of the woods yet in regards to the yield on the 10-year Treasury. We have to wait and see what happens. So basically, you have the Biden administration getting ready and wanting to push out a $1.9 trillion stimulus package. And the way that this stimulus package is paid for is with the bonds. So bond traders are worried that as this stimulus package comes through, the market's going to get flooded with bonds, and there's going to be more bonds in the market than there's going to be an appetite for through investors. And when you see that happen, yields have to rise because you have to increase the yields to create an appetite for investors to want to buy these bonds. So we're kind of seeing some, byproduct here of the stimulus package. I'm not here to debate with you whether the package is good or not. I'm just here to tell you that this is the impact of interest rates right now. We definitely have seen interest rates rise a little bit over the last 2 weeks. They're still phenomenal. We're locking in people at amazingly low rates. But yeah, we have seen a little bit of an increase, and we'll have to kind of wait and see what happens here as this stimulus package rolls through and how the bond markets take this in stride. I'm around all weekend. If you have any questions, let me know. I would love to help you any way I can. If you need a revised pre-approval done, a new pre-approval, or you just have general mortgage questions, call me on my cell phone, text me. Happy Friday. Have a great day.